Today we're looking at the Nigerian capital market and we're reviewing what 2013 looked like for most operators and projecting into 2014. I'm being joined on the program by two gentlemen. First, I'll be introducing Ayoleki Adu. He's the Managing Director and Chief Executive Officer of Morgan Capital Limited, and Dagogo Iyemo. He's the Managing Director and Chief Executive Officer of Ocean Securities and Stockbrokers Limited. Good morning, gentlemen, and thank you so much for joining me this morning.
Good morning.
Well, we listened to Tempo's report, and that's where we're going to start this conversation from. Your players in the market, what was your experience like for 2013? Did it meet your expectation, or was it a case of unfulfilled expectations?
Yeah, for us at Morgan Capital, I think it meets our expectation. Our expectation was that the market was going to witness about 40% growth, which was in our outlook for 2012. And we're happy that the market even surpassed that a bit by getting up to 47%. And the reasons have been mentioned why this thing went up to 47%. A lot of regulatory reforms have been taking place. Investor confidence is back. The focus on retail investors are beginning to kick in. And I think 2014 would also witness something similar, but maybe not as robust as what we have in 2013.
Dagogo, do you share the same sentiment?
Oh, sure. 2013, we could say that a lot of the adjustments in the system had come to some kind of stability. Okay, coming from 2007, 2008, and the challenges of the meltdown, okay, and then the banking sector reforms that were huge around us. Again, with the kind of success you saw of that program by the CBN, okay, and then the regulatory reforms, okay, the Nigerian Stock Exchange, the SEC, is trying to ensure rule-based supervision. That is to say, you just got to stick with the rules. You try to make operators and all stakeholders stick to the rules, and that has brought some kind of discipline, okay? And then we're seeing a situation where investors are beginning to be confident that maybe this has come to stay. Okay.
Now, one of the things that I know that happened this last year that's kind of put some sort of jitters in the market was the increase in the cash reserve requirement for public sector deposits by the CBN for banks. And so we saw most of the banking stocks come under pressure, and it took quite a while for them to get their feet back on the market. Has that actually or how did that actually affect the market towards the end of the year? Because we know that that came up sometime in the middle of the year. Year ending now, how did the market finish?
Yeah, I think we sent out a report in November last year, the impact of the CRR on the market. Of the 10 banks that we looked at, only 3 of them, Diamond Bank, Stanbic IBTC, and Zenith, were able to maintain some level of sanity in their year-on-year, quarter-to-quarter performance.
That's after that increase.
So you see that the CRR had a lot of impact. You see some banks that had reduction of up to 10, 15% quarter-to-quarter when compared year-on-year. So the impact is quite heavy, and I think investors would also see a lot of these things happening in the final year result. And that's one of the reasons why, to be frank, we can't really place a bet on how the market is going to go right from the second quarter this year to the end of the year, because a lot of things are up in the air. The way the central bank reacts to maybe a further increase in the CRR as a way to curb pre-election spending. You see, so there are a lot of uncertainties that will come up. Third quarter, the results are out, the impacts are there, but the final impact would be very obvious when the full year audit accounts.
Well, Dagogo, there was actually some speculation that right now the central bank has increased CRR on public deposits to 50%, and there's so much furore in the market. And there's a possibility that the Central Bank of Nigeria will actually increase it from 50% We don't know to what number, what percentage it's going to be at. But in light of the speculations that are bouncing around in the market, how should investors begin to look to investing in such stocks?
Well, the truth is, it is a huge effect, the CRR, that policy. And going forward, just like there is speculation that it may still go further higher. The truth is, the central bank, and you can't blame them because they're trying to tighten up much as they can, because if you like, the economy is being a little bit fiscally loose over time. Both the fiscal authorities and the monetary are doing a whole lot of work to tighten up, and the essence of all that is to drill down economic activities to the SME, to the retail level, okay, so that we all don't, the players, the banks, and most of these other players don't operate just at the wholesale, level. So you want to pull back a lot of that, a bit of that, so that banks, for example, can begin to look inwards and go down. And you remember when there was the last the one before the last consolidation exercise, where we had about 83 banks. Most of these banks were living on foreign forex trading. Now that had to be dealt with, and banks came down. Now that kind of policy will continue until the economy actually is set in the hands of the retail players.
Well, Ayaleke actually mentioned it, that in the course of a review they did as regards how the CRR affected some banks, last year, out of 10 banks, only 3 banks actually kind of had good top lines and bottom lines at the end of that review. Now, are we expecting that this might still replicate itself? This kind of situation might still happen again in the eventuality that the CRR is increased further from 50% to, I don't know.
The fact is, even if it's not increased further, we've not seen the full effect yet of that policy. That is to say, just like you said, in the first quarter we will see, and then going forward, we probably needed to wait till the end of this year to even see how far that policy would have. I mean, right now banks are still adjusting to rate. I still think, from analysis, we'll see that this policy will still, get banks shoving around it here and there up until the middle of the year.
Okay.
Now, another increase will obviously impact far heavily again. So, I would rather think that instead of another increase, because the full impact of that policy, we will begin to see, we saw the short-term effect over the last 2 quarters. We will see the full-term effect possibly after a full year, another, and then, maybe 2 quarters following that. So that policy has been massive, and I don't know, if another increase is in offering, then we may still have another wait to see how all of that will play out. But,
okay.
Yeah.
But is it most likely going to affect the way the market will take the news?
Well, the market will definitely react accordingly. I would think that if there is another increase, the market is likely to absorb that by dropping a little further, a little bit, and then applying caution in the positions that investors will take.
Now, another policy that I know that came up was towards the end of the year was the increase in the new capital requirement for capital market operators by the Securities and Exchange Commission. Now, for at least minimum, let me just make sure that I have those numbers correctly. Now, minimum capital requirement was increased from 70 to 300 million for some firms, from some stockbrokers, broker dealers, and then we had other increase in various other operators. A lot of reactions was generated when that happened. Dagogo, why are you smiling? Because a lot of people didn't understand why the stockbroking community would react the way it did, especially since the Securities and Exchange Commission was only trying to do its job of trying to ensure that you as a stockbroker had enough backing to carry the kind of risk that the market has.
Well, there are two sides to the argument, and but I like to point out that stockbrokers are not averse to an increase in capitalization, because there's been a harmonized position between stockbrokers, the exchange, about what nature and form this capitalization, this increase in capitalization will be over the last year and or so. Okay, so stockbrokers are not averse to an increasing, but I think that the challenge and the areas of disagreement, if you like, the timing, the sectoral increase from what to what in each of those categories.
Yes.
This policy has just come on. It's just been announced by the SEC over the last 2 weeks. So I think that the reactions are still not. They're still being digested and analyzed. We'll begin to see the full reaction. I think. Don't forget, we have a full year. So stockbrokers are not. They are prepared for an increase in capitalization, but they want it to be the best form applicable for both operator and regulator. For
what form would that be?
Well, you remember, that stockbrokers were the worst hit by the global meltdown. Okay, some of them, quite a lot of them, had to write down losses. Had some of them who invested in some companies that no longer exist today, some banks that were just taken off the market. So there is an adjustment period for that, and so stockbrokers are saying that, listen, we are going through this adjustment period. We are getting to stability point. Now we can't be talking about getting to stability point and then suddenly there's another upheaval again about capitalization increase. So why don't we discuss and say, look, this is the best route to take to this agreed destination.